Hello and welcome to Moneylife News and Views. I am Debashis Basu. Globally, share buybacks are an extremely popular mechanism for companies to return capital to shareholders, to right-size their balance sheets, and signal confidence in their financial health. For example, Apple Incorporated, the US company, has done buybacks worth $430 billion over the last 5 years, which has boosted its share price. It didn't need the cash. It kept buying its shares. The stock went up. It's a win-win for everybody. However, like every other aspect of economic activity in India, the only policy objective of the state has been to extract as much money as possible by taxing buybacks, leaving companies lukewarm to the idea and depriving shareholders in the process. This becomes immediately clear in a bear market when the stock prices of outstanding companies with strong cash flows are down, but none of them feel impelled to launch a buyback offer. Now, what can be done to encourage companies to buy back the shares in a move that would be highly beneficial for shareholders and the overall market? The legal and regulatory framework governing buybacks is primarily under the Companies Act 2013 and the Securities and Exchange Board of India Buyback of Securities Regulations introduced in 1998 and updated in 2018 and recently in 2023. Before this, the Companies Act of 1956 did not allow companies to repurchase their own shares, as it was seen as a potential misuse of corporate funds that could harm creditors or minority shareholders. The concept gained traction globally, particularly in the United States, prompting India to reconsider its stance in order to align with international practices and provide companies with far greater financial flexibility. So in 1998, SEBI introduced the buyback of securities regulations, which allowed companies to repurchase their shares either through the open market or via a tender offer. In 1999, Reliance Industries was one of the first to do a major buyback of shares, but the practice has remained unpopular due to onerous, really backbreaking regulations, lack of growth for corporates at that time, and low cash levels in companies. In the 2000s, when our economy started doing better, a few more buybacks happened, including a second one by Reliance of almost 3,000 crores through open market purchases. In 2010, buybacks became a bit more popular due to a combination of factors: economic growth, more cash flows, tax incentives, and maturing of the stock market. The Companies Act of 2013 replaced the 56 Act and further streamlined the process under Section 68, allowing companies to buy back up to 25% of the total paid-up capital and free reserves in a financial year. Buybacks also came to be seen as a better alternative to dividends due to their tax efficiency. Until 2016, dividends were subject to dividend distribution tax paid by companies around 15 to 20%, including surcharge and cess, while buybacks attracted lower tax, making them much more attractive. The Finance Act of 2016 introduced an additional 10% tax on dividend income exceeding 10 lakh for individuals, which in turn made buybacks even more popular. So in 2016-17, over 40 listed companies announced buybacks worth 30,000 crore, the highest value in a single financial year up to that point. This included Reliance Industries, which announced a 10,440 crore buyback plan between 2012 and 2013, though it achieved only 38% of its target, acquiring shares worth 3,900 crore. TCS, that Tata Consultancy Services, planned a 16,000 crore buyback in 2017, the largest ever through the tender route. TCS repeated large-scale buybacks in subsequent years, following a strategy of returning 80 to 100% of free cash flows to shareholders. Infosys also announced a 13,000 crore buyback in 2017. Interestingly, in 2017, the number of buyback offers exceeded initial public offerings for the first time in Indian capital market history. In 2019, around 70 companies did buybacks in the first half of the year, which was a record, the highest number ever, almost all of them rushing to complete their offers worth over 35,000 crore before the 2019 budget provisions taxed buybacks at 20% suddenly. In contrast, in the full year of 2018, only 63 companies bought back the shares. 63 in a whole year and then 70 in half a year because the government changed the rules. As expected, following the 2019 amendment, which imposed a lot more tax on buybacks, the number of buybacks fell to just about 48 in 2023. There was another round of tax changes in 2024. Buybacks are now taxed as dividends at the income tax slab rate for shareholders. They were taxed as capital gains earlier at 23.3%. So high net worth individuals and institutional investors now face higher tax liabilities up to 37% of the top tax brackets. In contrast, the US has only a 1% tax on buybacks, which also came about only recently under the Inflation Reduction Act of 2022. Also, from 1st April 2025, in India, open market buybacks through exchanges have been banned, which limits corporate choices. Now, if the government thought that it was freeing the corporate sector from buyback tax and shifting it on shareholders, it was a short-sighted view. While tax on buyback is not voluntary, choosing to participate in an offer is. Shareholders would hardly be excited about such hugely taxed source of income if you tax them like dividends. Share buybacks allow companies to enhance shareholder value, signal confidence, and optimize the capital structure. Firms with excess cash nowhere to deploy, like software giants, public sector companies, large fast-moving consumer goods companies, have utilized buybacks to reduce idle reserves when there are no worthwhile investment opportunities to make. Buybacks which use tax-paid past profits. So it's a tax-paid profit belonging to the shareholders, and so these ought to be left alone. But greedy, cash-strapped governments see buybacks as a means of grabbing more taxes. It is time for a relook in a declining market at buybacks. If the government puts a flat tax of just about 10% on buybacks, irrespective of income slab, hundreds of cash-rich Indian companies would go for it, probably increasing the government's overall total tax intake. A low flat tax policy will give a boost to the market at no additional cost and cheer millions of shareholders. These are the crucial points or junctures where an extractive state can turn itself into an inclusive state. Will it happen? Let's wait and watch. If you like this video, please do subscribe and do share. Thanks for watching.